How much do you need to pay in taxes on rental income from your rental properties? And is this income even taxable? These are some good questions, which is exactly what we're going to be talking about and answering in this video, so let's get into it right away. But before we do, if you haven't done so yet, or if you happen to be new here, welcome to the channel, and please make sure to hit the subscribe button right down below the video. Thank you, I really appreciate it, and let's get into it. But of course, I need to preface this video by saying, I don't know your situation, so I am not your accountant. This is not accounting advice. This is not financial advice or investment advice in any way at all. But rather, we're just talking through this, okay? So thank you so much for understanding. But let's get into this. Now, the real question is this income taxable? Well, technically, according to the IRS, all income is taxable, right? However, when it comes to rental real estate and income you get from your rentals, is that income still taxable? Well, technically, yes, it still is, but since it is from rental real estate, you have an ace up your sleeve, which we're going to be talking about in this video, so let's talk through this a little bit further. Now, here's the thing. When it comes to rental real estate, you should be having a real income, but yet on paper, you probably should have a loss on all of your properties every single year. Now, it is not a real loss, but rather it is a paper loss. Now, if you're new to the game of rental real estate, this is probably something that is still a little bit confusing to you, but that's totally okay, because welcome to the game. It's an amazing game, possibly the most important game you'll ever play in your whole life, especially if you want financial freedom and if you want to build wealth rapidly. You can do it through rental real estate. All right, so let's talk through this a little bit further now. So here's the thing. Let's talk about an example here. Let's just say you have a property. It rents for $1,500 per month. You have a mortgage on the property, you have taxes, insurance, upkeep, maintenance, repairs, things like this, possibly an association that you have to pay association dues, possibly you pay the utilities. You have all kinds of expenses, possibly even management fees if you manage it or if you have somebody manage it for you versus self-managing. Now, here's the thing. There's a lot of expenses when it comes to rental real estate, right? Everybody knows this. So let's just go back to our example. You rent the property for $1,500 per month. You have expenses of $1,300 per month, all expenses, right? So you cash flow a positive cash flow of $200 per month. $1,500 minus $1,300, $200 per month you get in positive cash flow. Over the course of a year, you have $2,400 of positive cash flow on that property. Now, is that $2,400 of positive cash flow actually taxable income? Well, in most situations, the answer would be yes. However, because of something called the big D, right? You know what the big D is, right? Well, it's a bad word. Yes, because of depreciation, you should have actually a net loss against the property, which makes rental real estate so incredibly powerful when you invest in this asset class. Now, here's the thing. Now, of course, over the course of the year, you have all of these different expenses. One really cool thing about rental real estate is you actually do get to depreciate the property for over 27 and a half years. So let's just say you bought the property for $200,000, for example. Let's just say you're allocating 10% of the purchase price of that property for the land. First off, you cannot depreciate the land on a property, okay? The land is not depreciable. However, the building is. So let's just say you allocate 10%. Now again, this is something I would advise you to talk to your accountant about. It's different in all areas. It could range anywhere between 10% and 20%, kind of anywhere in between, which is typically allocated for the value of that land. So here's the thing. Let's just say, for example, 10%. So $20,000 of that $200,000 purchase price is allocated toward land. Therefore, you have $180,000 that you get to depreciate over the course of 27 and a half years. Pretty awesome, right? So here's the thing about depreciation. You get to take that depreciation against any income on that property every single year. Now, I should have ran the math before I started this video, but whatever that would come out to on an annual basis. Now, of course, if you buy the property in the middle of the year, you wouldn't be able to depreciate for the full year. You can only depreciate for the days that it is actually rented or since you took possession and it is an actual investment property. So it's kind of like, a partial year basis, but let's just say it's a full year. You could take whatever that depreciation is. Again, I should have ran the calculation before I started this. But basically, you take that 180 divided by 27.5, and that would give you your full year depreciation. It'd get you pretty close. Of course, it's not the exact numbers. There's some weird calculations that go into it, but that gets you very, very close to what you could depreciate on that building every single year going forward for 27 and a half years on residential real estate that is a rental property. Now, this does not work on your home residence. No, that would be pretty nice, right? But no, it does not work there. It has to be rental real estate or an investment property of some kind, right? That is, and of course, it can't just be raw land. Raw land is not depreciable. So here's the thing. Going back to our original question, is rental real estate income taxable? Well, depends how you're doing it. If you paid cash for the property and you have no mortgage, no mortgage, and you don't have all the interest and all that stuff, then you're probably cash flowing far more than $200 per month. Therefore, you may have some income if it is not offset by repairs, maintenance, other fees like management, utilities, association dues, property taxes, all of that stuff. If your income is not offset by all of those other expenses, then at the end of the year, let's just say that you have a positive income from the property of, let's just say, $10,000, right? And your depreciation that you get to apply against the property is, let's just say, $3,000. Well, technically, you would probably have about $7,000 of taxable income. Well, that's not really where you want to be, especially with rental real estate, because of all of the massive tax advantages, mostly because of depreciation. So therefore, if you're somebody who has a mortgage on a property, which is a pretty nice way to leverage some money from somebody else, to leverage a property, then in most situations, all of that cash flow that you get throughout the entire year from your tenants, and you pay all your utilities or all of your expenses, things like that, because of depreciation, even though you had cash in your pocket, at the end of the day, at the end of the month, at the end of the year, you had positive cash flow. In most situations, depreciation wipes out all of that cash flow. Therefore, it is a non-taxable income, right? To be totally clear, all income, as defined by the IRS, is taxable income. But because of depreciation, and how you can actually offset all of that cash flow because of the depreciation that you get to apply against that property, technically, most of that cash flow or all of that cash flow should probably be zeroed out, as in no taxes on it, which makes it so incredibly powerful to invest in rental real estate. Now, here's another cool thing about rental real estate and another pro tip about this. Let's just say that you are somebody who earns, for example, $80,000 a year at your W-2 job, right? Or maybe you're self-employed, you have a 1099. Doesn't really matter. Let's just say $80,000 is what you earn. Let's just say you own 2 rental properties and they cash flow pretty nicely. At the end of the year, you reconcile everything, you zero out all of your income, expenses, things like that. And once you apply depreciation, you actually have a net loss of $3,000 per property, which would not be unheard of. In fact, you should be losing money on your rental properties every single year on paper. It should be a paper loss every single year. You should have a paper loss. Now, here's the thing. Let's just say you have those 2 rental properties. They cash flow nicely. You zero everything out because of your expenses, your mortgage, property taxes, utilities, management, repairs, maintenance, all of it, and then you apply the depreciation, and you lose $3,000 per property per year. Therefore, you have a loss of $6,000 against your 2 rental properties over the course of 1 year. Now, here's the cool thing. Provided your income is low enough, you could take that loss, that $6,000 loss, and apply it against your $80,000 W-2 salary, therefore lowering your W-2 income even more by another $6,000 because you earn under the threshold. Nice, not bad, right? So another way that rental real estate is really incredibly powerful, especially as you're running a loss on it. And if you have a 1099 or W-2, you can take those losses and apply it against your earned income, therefore, once again, lowering your tax liability. Yes, take that, old tax man, right? Yes, it's the best thing about rental real estate. It is incredibly powerful in so many ways. So, hope that helps you out. I have a bunch of other videos here on the channel talking about rental real estate, why it is so incredibly powerful, but this is just another way, the big old D, right? Double D's, right? Everybody loves some D's. Anyway, hope that helps you out. Pretty cool concept, once again, about rental real estate. There's so many cool things about this. I hope this gets you thinking a little bit. Go back and check out some of my other videos right here on the channel. Make sure to hit the subscribe button right down below the video. I will keep you posted with everything going on. I love talking about this stuff. I am a huge nerd when it comes to real estate, investing, cash flow, and yes, I'm about to say it, studying the tax code. Yes. It is something that I actually really enjoy doing. I love reading the tax code. Yes. Anyway, there's a lot of different provisions out there, a lot of ways that you can really lower your tax liability if you just invest in the ways that the IRS wants you to. And real estate is one of those ways. So, hope this helps you out. Hope it gets you thinking. Make sure to hit that subscribe button right down below the video. Go back and check out any of my other thousands of videos right here on the channel. Thanks, everyone. You're awesome. And I'll catch you again in the next video.